In this video, we're going to have a look at the financials of the French giant of Danone, a giant in the consumer goods industry. Now, just a quick Google search actually showed me exactly what kind of brands Danone is famous for. So, if any of these brands like Activia or Danimals or Danone Silk are familiar to you from the grocery store, they originate from the company of Danone. And recently as well, they did some acquisitions which also included Alpro, which I think I'm quite familiar with as well. It's a very famous milk substitution brand. So let's just dive directly into their financials. So what we can see here for 2012, their revenue or their net sales, as how it's presented on their annual reports, is just short of 21 billion here in 2012, which has risen all the way up to 24 billion in 2021. Now, just like with a company that we've looked at previously, namely Unilever, Danone very much expands their revenue mostly by doing acquisitions. Now, even including those acquisitions that Danone has been doing in the past, we can see that their revenue has not really been growing all that much. In fact, they've been growing by 1.7% year over year annually, which is, I think, even underperforming the inflation level. So I think, if anything, like a similar thing that we saw with Unilever as well, is that a company like Danone, a consumer product giant, is not really growing all that much anymore. And I think this is also definitely something that we have to take into consideration in the future. They have a very stable product line, but they do not have much growth potential. Looking at the EBITDA, so the earnings before interest, depreciation, taxes, and amortization. This is their flat earnings before anything happens, before any depreciation or amortization or taxes reduce this number. So what we can see here in 2012 is they posted earnings of about 4 billion, and 10 years later in 2021 they did about the same. So I think when it comes to their earnings, they have really been as flat as possibly can be. It's even showing here a negative earnings growth of minus 0.5%, which is decreasing relative to their revenue growth, which kind of means that they are less efficient in operating their business. So I think for the past 10 years, something has been going wrong with Danone when it comes to that. So a little side note here as well, because we'll be moving into depth in a little bit, that in 2017, Danone acquired White Wave, which is mostly known for the Alpro brand, and we can see also the revenue spike that came with that acquisition here in 2016 to 2017. They posted about 2.5 billion revenue increase in that year after the acquisition. But this acquisition was not free. This acquisition costed them about 8 billion euros. So looking at the debt level, what we can see is that they had 6 billion debt on their balance sheet in 2012, which has risen all the way to 10 billion here in 2021. Now, important to note though that after the acquisition, they had record levels of debt, even exceeding our 3x ratio, but they quickly realized this and started to pay down their debt every single year, which is very much what I like to see. And this also opens up the possibility for them to do some acquisitions, some big acquisitions in the future, because of course they still do acquisitions on a year-to-year basis, but those are mostly the smaller brands. Now, paying down their debt year over year allows them to maybe do a big acquisition again in the future. So looking at the excess cash, not much to say here. Relatively low levels compared to their overall debt level. So it started with 1.2 billion in 2012, which has decreased all the way to 500 million in 2021. Looking at market cap, we can see it's about as stale as their earnings are, which is kind of what we expect, because if a company does not show a lot of growth, of course it will not increase its market cap all that much. It's a very stable company. So looking at enterprise value again, like I always say, is the market cap to which we add the debt and subtract the cash. It's the entire value of the business, in a way that a competitor might want to buy out Danone, like, I don't know, Procter & Gamble or Unilever, or there's a merger. If that happens, of course, not only do you have to buy the shares from the market, but you also have to incur the debt that Danone has. So This brings us to the EV/EBITDA ratio, which is about as solid and steady as all the other numbers that came before this. On average, they are at about 11.2 times ratio, which means it takes about 11 years for Danone with their current earnings to pay back the entirety of their enterprise value. Net debt to EBITDA, like I mentioned, there was one little outlier here in 2017 after they did their acquisition of WhiteWave, but after that their debt level has been coming down steadily. So I think if anything, management is very careful with how they deploy their cash and how much debt they have on the balance sheet, which means it's a quite relatively safe business for us to look at, and the risk that we have as an equity owner are very, very minimal. Because what you have to realize is, the moment that a public company goes bankrupt, they have to pay down their lenders first. They have to pay down any outstanding debt to any of their suppliers, any of their employees, any of the banks that still have a loan with them. And only once they've paid everything back is there some compensation left for the equity holders, which is you and me who holds the share. We really don't want to invest in a company that has a risk of going bankrupt, because we have the risk as the equity owners of losing everything. Okay, so this brings us to cash flow, which I think by and large tells a very similar story. So cash flow has actually been at 2.8 billion in 2012 and has risen to 3.4 billion in 2021. Now this means, right, that they are actually growing out their cash flow from operations. So this is everything that's required to run their business. This is all the factories that are required to keep running. This is all the raw materials that they need to put in order to make their dairy products. And what we can see here is that they've been able to increase their cash flow from operations year over year by about 2%, which is very much what we like to see, because it means there's still some growth aspect to this company, which is mostly in the form of them being more optimized when it comes to handling the earnings that do come in. Even though the earnings by and large is decreasing, they are making more efficient use of what is coming in. So looking at capital expenditure. Capital expenditure is investment in any kind of new things that are required to keep running the business. It's the investment in a new dairy factory, is investment into new machines, is investment into new trucks, new delivery cars, new company cars, whatever you need really to keep running your business. Capital expenditure includes all of that. And what we can see is that the capital expenditure has been very much flat, similar to every other part of this company. Really, it's been quite flat. Free cash flow, similar to everything else we've looked at, is quite flat. So 2.4 billion in 2012, risen to 2.7 billion in 2021. So a slight increase there because they've been able to increase their cash flow from operations while remaining neutral on their capital expenditure. Looking at shares outstanding, we do notice that they are diluting their shares. So they are regaining funds by selling shares on the open market, which dilutes the share count for you and me, which means that our percentage ownership of the company is decreasing simply because the company itself is handing out more shares to the market. So this is something that I would not like to see, but of course that begs the question for you. So what exactly does Danone do with the free cash flow that comes in? So like we notice here, they use it to pay down their debt, which is very much a good thing, and they also use it to pay a pretty hefty dividend, I do have to say. I think they pay about €1.35 in dividend currently every single quarter. So that's more than, I think it's about €5 in dividend. Now, as you might have noticed, their free cash flow is not quite 5 dividends. So this means that they do have to dilute some shares or take out some loans in order to actually sustain that dividend at the current level, which I very much do not like to see. Like, I think Danone is very much a stable and stagnant company that does not really strive for growth all that much, because they're paying out pretty much all of their earnings out to their shareholders in the forms of dividends. Looking at price per share, it tells a very similar story as everything else, which is to say it's quite stale. For the past 10 years, it's only been a 1% move in their share price. if you're thinking about buying or selling calls or puts on any stock because you kind of expect them to be at around the same level, historically Danone is the bet that you want to make. So looking at their free cash flow yield, again, it's quite stable. It's on average about 5.7%. It's been higher here in 2021, but it's also been a lot lower here in 2015 at 3.9%. So this brings us into the business of trying to forecast Danone, which I think is relatively easy to do, seeing just how consistent their earnings, financials, cash flows, everything has been historically. So let's have a look at their EBITDA numbers. So historically, their earnings have been decreasing by about 0.5% per year. Now, if I want to forecast this business, I try to take the number here from 2021, which was one of their lowest numbers historically. Okay, so I think it's a very conservative year to begin with to project the earnings growth. But I'm going to take this number anyway because I think it's a perfect way to start off our conservative projection. But afterwards, I'm going to give them the benefit of the doubt and say they will probably grow their earnings by about 1%. Because if I look at this number and this number was equal to the year prior, we can see that on average their earnings have been growing at 1%, if not for the final number here in 2021. So I think they're able to maintain that 1% earnings growth, especially with the brands that they currently have. With I think Alpro, the milk substitutions are becoming quite popular in the grocery store. So I think there's definitely some growth for them there to get some additional market share when it comes to the dairy business. So I'm going to give them the 1% EBITDA growth year over year. So if I grow their earnings by 1% every single year and I give them a market multiple of 10 times, on average they've been around at 11 times, but I want to be conservative with my estimates, so I'm going to give them 10 times. And this gives me an enterprise value 10 years from now of 42 billion euros, to which we subtract the debt, add the cash, gives me a market cap of 32 billion, divided by the amount of shares outstanding, and I'm just going to assume that stays the same because I'm not quite sure what will happen, which gives me a stock price 10 years from now of 48 euros and 26 cents. Now we're going to do a similar thing here for their free cash flow. Now with free cash flow as well, they've been relatively stable here historically. So I'm going to take this last 2021 number and I'm going to increase that by 1% in line with their earnings growth, because they have been shown that they've been able to be more efficient with the earnings that are coming in, and I'm going to give them the benefit of the doubt and say they can also do the same for their free cash flow. I'm going to give a starting number of 4.05 euros, which is not quite as conservative as can be, because they definitely had way lower numbers than this. But given how efficient they've been running their operations lately when it comes to their cash flow, I do think this might be an accurate number to actually project into the future. So I'm going to give them a 1% growth here year over year. I'm going to give them a free cash flow yield of 7%. Now historically they've been 5.7. 7% is definitely on the high end of things, but this is again because I want to be conservative. If I reduce this down to 5%, you will just see exactly what will happen here to the share price. It will increase by quite a bit, but that's not conservative enough for me. If I want to make a purchase into the stock market, I want to make a projection that is very conservative. And if that conservative projection beats the stock market, that's when I'm going to be interested. Okay, so now we've got two price projections into the future. I can currently buy as many shares as I want for 50 euros and 70 cents. If I take both my projection and cut them down the middle, I get an average share price 10 years from now of 55 euros and 81 cents. Simply looking at their share price, this is about an increase of 1% year over year, which is very, very minimal change. Again, if you're into selling options, it might be an interesting one here. But when we include the cash flow, because like I mentioned, the cash flow that they generate is pretty much divvied out to the investors. So you get compensated simply for holding the stock. And if we include the cash flow that's coming your way into our analysis, I project a 10.5% IRR every single year. Now I always say on average the stock market returns about 10% a year. So when it comes to that, I think Danone is kind of performing in line with expectations. It's a very stable company. There's not much going on. There's not much of a growth story to be had here. It's very, very stable. Now, these are with relatively conservative estimates, although I do give them a 1% growth year over year, and I did take a very high free cash flow per share already, in all fairness. And the moment this comes down, let's just give them a €3 here. I'm just going to give them 3. What you see is that their IRR, as well as their compounding annual growth rate, starts to come down drastically in a way that even underperforms the market. So if you do not believe that this €4 is an accurate free cash flow level, you think it's even more conservative than that, give them a 25% haircut. At this moment, the share price is no longer interesting for me as an investor. But I'm going to revert back to this number, and I'm going to see what will happen to our IRR if the share price comes down just a little bit. So if the share price comes down by 10% to €45.63, I can expect an IRR of 12.4%, which is still not really that impressive, but it's very stable. And if you're building a value portfolio that is stable over time, then I think Danone is definitely interesting for you. It's just not interesting for me because I think the growth potential of this company is very, very limited and is not the right risk-reward ratio for me. Now, if it comes down about 30% to €36.50, at that moment I'll be interested. At that moment it will promise an IRR of about 17%, which is very much outperforming the stock market. But for that, the share price has to come down 30%, which is probably not likely to do anytime in the future. At this moment, I would personally not be interested in investing into Danone, but whether or not you are, that's completely up to you. Of course, this is not financial advice. You are free to make your own decisions. So this was an analysis of the Danone stock. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!